In the span of 48 hours, silver went from roughly $121 an ounce to the high 70s, and gold slid hard enough to make seasoned traders stop mid-sentence. Not months, not weeks, 48 hours. The move wasn't just large, it was structurally wrong for what most people think these markets are. Deep, liquid, and too institutional to lurch like a meme stock. And yet it happened, right in front of everyone, on screens that update every second. What makes this episode different is not the volatility. Metals can be volatile. The difference is the timing and the mechanics. This wasn't a slow change in public sentiment. This was a lever being pulled in the plumbing of the market. And once it was pulled, the math did what the math always does. People talk about supply and demand. They talk about inflation stories. They talk about fear. But in a leveraged futures market, the first law is collateral. When collateral requirements change, the entire price path can change with it. Here's the part that should get your attention. The institutions did not discover this after it happened. They were watching the same risk controls you weren't watching. They were watching margin frameworks, open interest, clearinghouse notices, and the subtle shift from fixed dollar margins to percentage of notional margins. They were watching the exact moment leverage would be repriced. And once leverage is repriced, the crowded side of the trade is forced to sell whether they want to or not. What I'm about to lay out is not a conspiracy story. It's a mechanical story. It's a story about how modern markets can appear calm for a long time, then collapse into speed because the system is built on borrowed exposure. And when the rules of borrowing change, prices don't drift. They gap. Welcome to Vaultline, the place where we decode what the market is doing before it becomes the headline everybody argues about. If you like analysis that starts with the paperwork and ends with the pattern, stay close. And if you're listening the way you'd listen to that one wise elder who doesn't talk much but always seems to know what's coming, you already know what to do. Also, tell me where you're watching from in the comments because it helps me see where this conversation is landing. Now let's reconstruct what happened with dates and numbers because the timeline is the key. Silver did not simply decide to drop. It was first pushed higher by a mix of speculative momentum and cross-market positioning, and then it was snapped lower when the system's leverage constraints tightened at the worst possible moment. At the top, reports had silver near $121 an ounce. 10. That is not a gentle correction. That is a collapse that forces liquidations, triggers risk limits, and turns what looks like a market move into a market event. Gold moved with it because gold and silver are joined at the hip in the way leverage is managed across portfolios. When one leg starts bleeding, risk desks don't politely isolate it. They cut, they reduce, they bring the whole book back inside limits. You could see this in the behavior of futures positioning and in the way trading activity spiked even as open interest started to fall. On February 2nd, COMEX gold futures volume was reported around 434,930 contracts. That's activity. But open interest was around 451,079 and it was down by 25,997 from the prior session. That combination matters. High volume with falling open interest is the signature of liquidation and position reduction. It's the market telling you that exposure is being removed, not simply rotated from one opinion to another. And then there's the clearinghouse step that turns a bad day into a forced day. On January 30th, 2026, the CME Clearinghouse issued an advisory numbered 26-441 that raised margin requirements for precious metals. The gold margin for non-high-risk accounts moved from 6% to 8%, and silver moved from 11% to 15%, 5%. These are not small tweaks. In a leveraged market, a few percentage points of margin is the difference between holding a position and being compelled to liquidate it. This came on the heels of another clearing advisory earlier in the month, 26-019, dated January 12th and effective January 13th, which moved precious metals margins to a percentage of notional approach. The examples in that framework were blunt. A 100-ounce gold contract with a 5% initial margin was illustrated at $24,000, and a 5,000-ounce silver contract with a 9% initial margin was illustrated at $32,500. In plain language, the higher the price goes, the higher the required collateral cost of maintaining the same exposure. So when silver surged and gold climbed, the collateral cost of staying long rose with it. Then, when the clearinghouse raised margin rates again into the February 2nd close, the system essentially demanded even more cash for the same exposure, and demanded it immediately. If you don't post it, you don't get a debate. You get a liquidation. And that demand isn't a theoretical demand. It shows up as an email, a phone call, a notification from a futures commission merchant that says, in effect, post additional funds by the deadline. Sometimes the deadline is the next morning. Sometimes it's the same afternoon. That is why moves like this feel like a trap door. The market can trade for hours on optimism, and then the credit terms change, and suddenly the same position requires a different amount of cash to exist. To see why the change from 11% to 15% on silver is so potent, Translate it into a single standard contract. A COMEX silver futures contract represents 5,000 ounces. If silver is at $100 an ounce, that one contract is $500,000 of notional exposure. At an 11% margin rate, the required collateral is about $55,000. At a 15% rate, it's about $75,000. That is a $20,000 cash difference per contract, overnight, before you even account for mark-to-market losses from the price drop itself. Gold works the same way, just with a different scale. A standard 100-ounce gold contract at $2,000 an ounce is $200,000 notional. Moving from 6% to 8% takes required collateral from roughly $12,000 to $16,000 per contract. Again, it's the change that matters because it hits at the worst time when losses are already eating equity and when risk managers are already nervous. And here's the cruel detail. The higher the price had climbed, the more notional exposure every contract carried, and the more collateral the system demanded. That's why blow-off tops in leveraged markets are fragile. They aren't just expensive. They are expensive to finance. The crowd feels rich on paper, but the collateral bill is real, and it arrives on schedule. Once the bill arrives, there's no negotiation with the tape. If a fund can't wire cash fast enough, it reduces positions. If a broker is uncomfortable with the volatility, it reduces positions. If a risk model sees a spike, it reduces positions. Each reduction is a sell order, and each sell order pushes price, which raises volatility, which tightens the system further. That feedback loop is what people experience as a sudden crush. So when you hear someone say, metals were attacked, translated into a simpler statement. The financing terms tightened and leverage had to come out. Whether you call it an attack or safety measure, the consequence is identical. The lever was pulled in the rulebook, and the market responded in the only way a leveraged market can respond. And remember, initial margin is only the entry ticket. Maintenance levels, variation margin, and intraday calls can escalate fast, turning a normal dip into a funding emergency. This is where most commentary gets it wrong. People think margin changes respond to volatility after the fact. Sometimes they do, but they also function as a brake that can be applied into a crowded move. Whether intentional or simply risk management, the effect is the same. It changes behavior and accelerates forced selling. Now, to understand why this feels familiar, you have to zoom out. In 1980, silver became the center of a historic squeeze narrative, and the blow-off was followed by a rule and margin environment that turned the market over. The result was a collapse that punished leverage and rewarded cash. In 2011, silver again surged, and then margin requirements were raised repeatedly in a short span. The result was a sharp reversal that looked inexplicable if you were only watching the price, but obvious if you were watching collateral. In 2013, gold experienced a violent breakdown after a long stretch of confidence. And the move was amplified by liquidation pressure and the realization that the one-way trade can become a two-way trade overnight. Different decades, different headlines, same internal logic. In each of these episodes, the public story was about fundamentals. The private problem was about leverage. When the trade becomes crowded, the market becomes less about the right price and more about who can finance their exposure through a volatility spike. And when the financing cost changes, the market can move faster than any fundamental model can update. Now let's talk about the players, because the players are not just banks and traders. The players are the institutions that set the rules of collateral and the venues where leveraged price discovery happens. Start with the exchange and the clearinghouse, because they sit at the center. CME, through its clearing function, defines initial and maintenance margin. Those numbers determine how much cash a participant must post to hold a futures position. When those percentages rise, every leveraged participant has to come up with more cash. That includes speculators, funds, and even hedgers who are hedging real-world exposure, but still must post margin to the clearing system. Then consider the prime brokers and futures commission merchants, the intermediaries that extend credit and manage client risk. When volatility spikes, these intermediaries raise internal requirements beyond the exchange minimums. That's the second lever. Even if the exchange margin is one number, your broker's house margin can be higher. When everyone tightens at once, liquidity disappears at the exact moment it's needed most. Add to that the risk managers inside the large funds. Many of them run exposure limits based on volatility and value at risk frameworks. When volatility rises, their models tell them to cut exposure. They don't do it because they want to. They do it because their mandate says they must. That's the third lever. The model says reduce, so they reduce. Finally, overlay the macro policy shock that added fuel. When the market is positioned for one interest rate path and suddenly has to consider another, the valuation of non-yielding assets like gold shifts in the narrative. Even if you think that narrative is wrong, it can trigger de-risking behavior in portfolios that are built on correlations. And when those correlations flip, a diversified portfolio can become a concentrated risk in a single afternoon. Put those together, and you get a coordinated-looking outcome without anyone needing to coordinate. The timing aligns because the incentives align. A clearinghouse sees rising volatility and raises margins. Brokers see rising volatility and raise house requirements. Funds see rising volatility and cut risk. The market sees forced selling and lowers price, which increases volatility further. The loop feeds itself. Now, here's where it gets interesting because while the paper price was collapsing, the physical ecosystem told a very different story. Look at London's vault data, for example. At the end of December 2025, the reported holdings were around 9,106 tons of gold, roughly 728,512 bars, and around 27,818 tons of silver, roughly 927,254 bars. That's not a small stash. That's a massive physical inventory in one hub. It doesn't mean it's all for sale. It doesn't mean it's all available. But it does mean there is a huge base of physical metal sitting in custody while screen prices are behaving like a crisis. So how can both be true? How can the world be short of metal in narrative while inventory looks enormous in data and price collapses anyway? Because futures prices can move faster than physical flows. Futures are a leveraged instrument. Physical is not. Futures can be sold instantly in massive size with minimal capital, as long as the margin is met. Physical cannot be dumped into the market at that speed without logistics, assays, delivery constraints, and real-world settlement. That's the dislocation. Paper can collapse while physical is stable. Paper can spike while physical is unchanged. Paper is a price discovery mechanism, but it is also a leverage mechanism. And when leverage is forced to unwind, the paper market can print a price that looks like a fundamental truth, but is actually a financing event. This is the part no one is discussing when they say gold is down, therefore inflation fears are over, or silver is down, therefore industrial demand is weak. Those may be true later, but in the moment of a margin-driven unwind, price is being set by who has to sell, not who thinks. Now add one more contradiction that makes this episode feel so unsettling. During leverage events, the screen price is often the noisiest signal, while the quieter signals are the ones that reveal the underlying strain. One signal is positioning, another is inventory. Another is the behavior of spreads and the way liquidity behaves across venues. When you see heavy volume and dropping open interest, you're seeing the crowd step away from the edge. When you see vault totals remain immense, you're seeing that the physical base is not disappearing in 2 days. The two truths coexist because they operate on different timescales. The paper market is a speed market. The physical market is a settlement market. In a speed market, the fastest seller sets the print. In a settlement market, the ability to deliver, finance, and transport sets the reality. When the speed market is forced to unwind, it can overshoot in either direction. That overshoot becomes the headline, but the settlement market is where longer arcs become visible. Now, let's go deeper into the evidence because the numbers are the fingerprints. First, the margin rates. Moving gold from 6% to 8% sounds small until you translate it into dollars. Imagine a participant holding a large notional position. An extra 2 percentage points of notional collateral is a demand for cash right now across the entire book. If the market moved against them at the same time, their losses are already consuming capital. Now the system asks for more capital. That's a squeeze. Silver moving from 11% to 15% is even more brutal because silver's volatility is higher and the contract size is large. A 5,000-ounce contract means a $1 move is $5,000. A $10 move is $50,000. When silver moved dozens of dollars, the mark-to-market losses were enormous. Now add higher margin percentages, and the required cash becomes unmanageable for anyone running too much leverage. Second, open interest falling. The reported open interest in COMEX gold futures around 451,079, down by 25,997, tells you positions were being closed. That suggests that some participants were not rolling or adding. They were exiting. When open interest drops during heavy volume, the market is shedding exposure. That is exactly what you see during forced liquidation. Third, the shift to percentage of notional margins. When margins are fixed, a price spike can make leverage easier relative to rising notional. But when margins are tied to notional, a price spike automatically demands more collateral. That feature can dampen runaway moves, but it can also make the unwind more violent, because the most expensive part of the trade is the top, and the top is where people are most leveraged. Now, let me explain the mechanism in plain terms. Imagine a crowded theater where everyone is standing on chairs to see better. As long as the floor is stable, people can balance. Now imagine the building manager announces that every chair must now have a safety harness attached and you have to pay for it immediately. Some people can pay, some can't. The ones who can't must get off the chairs right now. When they step down, they bump others, and those others lose balance and step down too. The visibility collapses. Not because the show changed, but because the rules of standing changed. Margin is the safety harness. Collateral is the payment. When the cost of holding a leveraged position rises, the weakest hands are forced out first. That selling pushes price down. Price down increases volatility. Volatility triggers more margin and more risk cuts. The cycle repeats, and it happens fast because it's not driven by persuasion. It's driven by rules. Now, there's another layer that amplifies the move: cross-asset margining and portfolio correlations. A fund doesn't hold only silver, it holds a book. If silver collapses, the fund's overall equity shrinks. That can force reductions in other positions, including gold, even if gold's own story hasn't changed. At the same time, brokers look at the overall risk of the account, not just one contract. If one corner of the book is on fire, they tighten the whole account. That can force selling across assets, and it's why these events often look like everything is down at once, even when only one thing sparked the first flame. This is also why you often see the most emotional narratives appear after the mechanical damage is already done. People need a story, but the clearing process doesn't need a story. It only needs collateral. So what does this mean going forward? Not a prediction, a pattern. Historically, when you get a margin-driven liquidation event in metals, you get an aftershock phase. The first phase is the break, where leverage unwinds. The second phase is stabilization, where open interest resets and volatility compresses. The third phase depends on whether the underlying demand, whether industrial, monetary, or hedging, demand reasserts itself at the new level. There are three broad scenarios to watch. In the conservative scenario, the forced selling ends, volatility cools, and the market builds a base. You'll see this in declining daily ranges and a flattening of open interest, where it stops falling. You'll see spreads normalize, and you'll see volume return to ordinary levels rather than panic surges. In the moderate scenario, there's a second flush. This happens when the first wave of liquidation is followed by a wave of risk model selling as lagging volatility measures catch up. The first wave is margin calls. The second wave is mandates. If that unfolds, you may see another sharp down day even after a brief bounce, because the systematic sellers are slow and relentless. In the aggressive scenario, the dislocation between paper and physical widens. That can happen if physical demand shows up strongly at lower prices, while paper positioning remains cautious. In that case, you may see backwardation pressures, local premiums, or delivery-related stress signals, even if the futures price is still low. The key is not the headline price. The key is whether the physical market is absorbing supply faster than the paper market is willing to price. So what should you watch if you want to understand the next act? Watch margin notices and clearing advisories, because they tell you how the system is pricing risk. Watch open interest, because it tells you whether the market is rebuilding exposure or still shedding it. Watch volume relative to open interest changes, because that tells you whether activity is new conviction or forced exit. Watch volatility metrics, because they drive risk limits. And watch the subtle indicators of physical tightness, like persistent regional premiums and changes in reported vault flows that deviate from the usual rhythm. Now we arrive at the divide. There are two kinds of people in episodes like this: those who follow narratives and those who follow mechanics. It's not about being smarter. It's about paying attention to the signals that move first. Narratives move last. They are written after the tape prints. Mechanics move first, because mechanics are rules, and rules don't wait for consensus. The wealth gap in markets is often an information gap. Institutions watch collateral, liquidity, and clearing conditions. Retail often watches headlines and price charts. By the time the headline says crash, the forced sellers have already sold. By the time the headline says safe haven broken, the margin hike has already been applied. The sequence matters. And this is why the title of this episode is not about whether gold or silver should be higher. It's about how a lever can be pulled in the infrastructure and how that lever can turn a popular trade into a stampede. When you see silver drop from around 121 to around 77 in a moment, don't stop at the emotion. Ask what changed in the financing. When you see margin rates jump from 11 to 15% on silver and from 6 to 8% on gold, don't treat it like trivia. Treat it like a gravity switch. Because in leveraged markets, gravity is collateral. This is Vault Line, where we decode what matters before it becomes tomorrow's argument. If this connected dots you hadn't connected, you know what to do. And the real question isn't whether markets will remain volatile. The question is whether you'll recognize the difference between a fundamental move and a mechanical unwind while it's happening.